This series is supported by Apollo Global Management, a leading provider of alternative asset management and retirement services solutions. Apollo seeks to provide clients excess return at every point along the risk-reward spectrum and is focused on empowering retirees, building and financing stronger businesses, and driving a more sustainable future.
A lot of times people ask, what keeps you up at night? And it's not so much the problems. What I lose sleep about is thinking about how I can improve and how I can continue to grow the portfolio, thinking about new things that we can implement to either save cost or make the portfolio more efficient and balanced, or just support the team as well as we work through 2024.
I'm Ethan Devitt, and welcome to the 50 Faces podcast, a podcast committed to revealing the richness and diversity of the world of investment by focusing on its people and their stories. I'm joined today by Angela Miller-May, who's CIO at Illinois Municipal Retirement Fund, a public defined benefit fund based in Oak Brook, Illinois. Angela is a regular figure on the asset management conference circuit and has become a leading voice in promoting diversity and inclusion in the industry. Welcome, Angela. Thanks for joining me today.
Thanks for inviting me again.
Well, that was why we wanted to invite you back. You were one of the very first guests of this series, one of the first 5 guests. And we were really privileged to capture your story then in the summer of 2020. Quite a bit has obviously changed since then. And we wanted to check in on your current journey and your point of that journey and hear what's changed.
Well, what's on my mind first of all, I would love to talk about IMRF, and I will, because I joined IMRF in August of 2021 as Chief Investment Officer, exactly a year after I spoke with you on 50 Faces in 2020. So I remember speaking to you like early on in the beginning of 50 Faces, and you were saying that you wanted to interview 50 diverse voices in the investment industry. And fast forward, you've interviewed more than 200 plus professionals, and you've opened up an office. And I just want to congratulate you for all of your accomplishments and having a vehicle where these voices can be heard. So we've done a lot in the last year or two. And so I wanted to first thank you for all that you do. And so as Chief Investment Officer, I lead a team of 16 professionals, including an internally managed equities team, which was a new venture for me. I had never managed any assets internally at Chicago Teachers. IMRF is a $52 billion fund that services over 457,000 members and 3,030 employers, a little more than 4 times the size of Chicago Teachers. And the membership is just about 4 times the membership. We're 98.2% funded. We have 7.25% expected rate of return. And those data points let me know that IMRF, when joining, was a strong and well-funded, well-run pension fund. But what really attracted me was the mission, the vision and the values and the culture at IMRF. 2020 and 2021, when I joined, I was still working from home 100% of the time. So I think I craved being around people, being, working and collaborating, and just a culture outside of my house. And it simply was an organization that I wanted to be a part of, and where I believed that I could bring value to the members and the stakeholders of IMRF. Of course, I did not predict that the markets and frankly, the world was about to change drastically. But even with the changes, IMRF was a place where I had opportunities and flexibility to not only protect the portfolio in those challenging times, but also position the portfolio to kind of take advantages of opportunities that may present themselves in the future. So for me, it was a place to grow both professionally and personally, and a place where, I felt like my purpose and my passion for investing could be expressed simultaneously. So that was kind of why I joined IMRF. Fast forward to now from the last time we talked. And then when I think about what's currently on my mind, trying to steer this large ship through these tumultuous times, I feel like now, like the only certain thing is uncertainty. We've had some volatility across 2023, and this last quarter has been fabulous. But now, reality is setting in a little bit in January, and the markets are kind of up and down. But inflation, high interest rates, when the Fed is going to cut, the geopolitical crisis, Russia, Ukraine, Israel, the banking crisis, possible government shutdowns in February. It's so much that I think about, like, constantly. The divisiveness in the US, the political divisiveness, the migrant crisis, and the impacts that all of these things will have on the markets and IMRF's portfolio, as well as the impacts to me, both personally and trying to maintain my sanity. But often wonder why we are so busy. We are extremely busy, and we have been for the last 2 years. And I think maybe it is just because we're working like nonstop to stay ahead of the markets, to figure out solutions, resolve any problems in the portfolio, to be creative, to continue to grow, but also to protect, to find strategies that can give us current income as well as long-term returns. So I think that's kind of why we've been so busy and we'll continue to stay busy. We've run a couple of major, huge RFPs. We've hired a lot of managers, both in private equity and real estate over 2023. And we're looking to do just a structural review of all of the asset classes, public markets as well as private markets. So it's a 24/7 job. It's constantly on my mind, mostly because of what's at stake, the financial well-being of our members. And, a lot of times people ask, what keeps you up at night? And it's not so much the problems. What I lose sleep about is thinking about how I can improve and how I can continue to grow the portfolio, thinking about new things that we can implement to either save cost or make the portfolio more efficient and balanced, or just support the team as well as we work through 2024. So hopefully I answered your question.
That is so well put. And you're absolutely right. This is a 24/7 rent of one's mind, certainly, that goes on in terms of mind share. And I think you're right too. There's no comfort zone in these markets. There's no ability to rest on one's laurels and clip coupons. I think there is that emphasis on reaching for that next return, uncovering a new source of return. There's a lot of pressure. I understand that. Because this is quite a different fund in terms of funding level, size, perhaps status generally as a fund versus Chicago Teachers Pension, where you were when we last spoke. How does that funding level affect your approach to investing? Do you have a perhaps more bandwidth, more different time horizon, different comfort level with different investments?
So when I think about it, IMRF is fully funded and financially sound and not as liquidity strained as Chicago Teachers. And that offers us more flexibility, more access to opportunities. We think long term and we invest long term, but we consider some of the same risk as Chicago Teachers, and we choose to remain invested, but we raise cash to pay benefits monthly just because we choose to remain fully invested, not because we have to liquidate funds. And so we're constantly looking at our risk, which managers are contributing the most risk. That points us to where we should raise cash from, where we should take some money off the table when we have those growth managers that are continuing to grow. It's a good problem to have. And so we just position a portfolio to protect, but we're not afraid that our funding level is going to drop. And we constantly think about, it's 98% funded. How can we get to be 100% funded? And how can we implement strategies that really get off enough cash to pay those benefits? And when we do that, it allows us to look at the portfolio a little differently about what should be in the portfolio, what strategies should be in the portfolio, which managers we should be hiring. And recently, we thought about the fact that private credit can give us double-digit returns without taking equity risk. So in our last asset allocation, we actually brought down our equity targets and we commenced to meet the 4% private credit target that we implemented in the asset allocation. So we went through an RFP process. We started to hire managers. We started to build the private credit portfolio. We thought about our cost to invest in private equity. We implemented a co-investment program that we are managing ourselves. We started a third internally managed portfolio for small cap, and we brought some more assets in-house. And so these are the things that we can do, the flexibility that I talk about, the solutions, the creativeness that we can actually perform in the portfolio when we're not constrained by being underfunded. And those things have been beneficial for us. And I'm very excited for 2024, 2025 to see how this 3-year implementation plan that we've put in place really shows up in the portfolio through additional returns and increased returns across the next 2 years.
So this was the plan that you put in place, this 3-year implementation plan. Was it when you joined?
It was actually, we started it in 2022. Well, actually, that was, after I got to know the portfolio and the team, 2022, when we reviewed our asset allocation policy and we did a asset liability study, we changed the targets, but I thought it was ludicrous for us to ramp up to the targets and to, have to move money in such a way that we were either out of the market or we were taking on losses that we didn't need to because 2022 was such a down year. So I decided to, here are our targets, but every year those targets will change, those benchmarks will change till we get to 2025, which is our long-term asset allocation. So this particular year in 2023, we've been ramping up to add 1% to our private credit and reduce our bank loans. Next year, it'll be another percent. So we're moving slowly. We're beginning to assess every year where the markets are, where we are, and if we should continue with the plan that we've implemented. So it's just a more gradual, thoughtful, being able to evaluate along the way, moving slowly, cautiously, but in the end, getting to those long-term targets.
And as we know, time flies. Those 3 years, you'll be looking back before we know it. On the internal equity program, you mentioned that was already in place when you joined, you've now expanded it. How much of that is driven by cost savings? And what would you say some of the advantages and maybe challenges are? Because many peers, I'm sure of yours, would like to consider running equities in-house, but it's not necessarily an easy undertaking.
Well, when I came, there were 2 large cap factor-based strategies, and really all 3 strategies are factor-based. So they fit kind of in the portfolio between our active managers and our passive managers, really drilling down on those factors that are a source of returns for large cap equities. And so it was a challenge for me at first trying to understand how the team fits. It was kind of separated from the public markets. So I spent time trying to integrate the two, trying to have lessons learned from the internally managed team over to the externally managed team, trying to understand strategies, where we should expand. It is beneficial in that the returns have been really good, trying to manage the amount of assets that it's a 3-person team, thinking about when we should grow the team, when we should add another portfolio, which we decided to add the small cap portfolio. And much of it is saving cost over time, assessing whether the internal team can do what our external managers have done or are doing for the portfolio. So it's more of a matter of them not necessarily trying to outperform external managers, but giving us the same exposure to the same factors, but also saving us on cost. I think what is also been challenging are the resources, the systems. We use maybe 3 or 4 different external benchmarks. We use Northern Trust for trading. And so we're trying to think about how we can bring it more internal. We've been running a paper portfolio on the side to try to understand what are the other things that we can bring in-house? What are our capabilities? What is too much for us and should be done by external managers? So it really is trying to balance it out, trying to make sure that we have the talent, we have the capabilities, we have the resources and tools that we need in-house. So I think all of those things need to be considered when you think about having an internal team, an internal portfolio. And I don't want to brag, but my internal team has actually written a white paper about 10 lessons that they've learned over the last 3 years in managing internal portfolios. And so I believe it's on our website, but it is really just a thoughtful piece for other investors when they're thinking about investing internally.
Well, I'll be sure to link to that in the show notes. It sounds very interesting. We're going to take a short break to hear from the supporter of this series, Apollo Global Management. I sat down with Joe Moran, Managing Director, Institutional RIA Sales at Apollo. I asked him how Apollo was evolving, particularly as it works with clients in the wealth segment.
Apollo is focused on building out a holistic ecosystem dedicated to the wealth channel, not only managing private market assets, but also building differentiated products and structures that are fit for purpose, supporting and delivering educational resources to the marketplace, and providing high quality marketing and servicing for individual investors and their families and advisors.
And now back to the show. Our last conversation, we spoke a lot about the strides you were making in terms of promoting diversity and inclusion, both within your own team at Chicago Teachers, but also within your portfolio, and using diverse and emerging managers in the portfolio in a meaningful way. How have you continued to have this as part of your mission at IMRF?
Well, it is a part of the culture at IMRF. We really strive for organizational excellence. And part of that is having a diverse team at IMRF, investing in diverse managers and diverse brokers. And so, I had an open position and I was able to add more diversity to our team, first of all. We've also increased over the last 2 years. When I joined, we had diverse managers managing just about 21% of the portfolio, and now that's grown to 26%, just about $13 billion. And we're looking for ways of how to continue to grow the management of assets by diverse managers. We've also implemented what we call diverse manager days, which is like a little spinoff of Chicago Teachers First Friday. But we wanted to really engage with the managers. And so we set it up where we've seen this last quarter, 18 managers we've hosted and brought them into IMRF. And we had a presentation from IMRF. We had a presentation from our consultants, Wilshire, educating the managers on how to continue to engage with both IMRF and Wilshire. Then we sat down with each manager, having a representative or a researcher from Wilshire and a representative from our team as well. And we spent an hour and a half with each manager over a 3-day period for the last quarter. And we want to continue this throughout next year. We've issued a survey to let the managers let us know, what we could do better. And we're also following up with those managers to give them feedback. So this is something we want to continue. We also started roundtables for our brokers, really looking at opportunities across the private markets for our minority brokers. So we're just digging in and engaging more, trying to understand, it's not just about trying to look at it holistically. It's not just about the targets. It's about making lasting and sustainable change. And so we are even thinking about how we look at diverse-led managers, not necessarily diverse-owned, which the Illinois Pension Code says that it has to be 51% owned to be diverse-owned, but also looking at managers where their organization is diverse and they're diverse-led, like their senior professionals are women or women of color or minorities, because they are making changes within their organization that will also lead to more diverse people in this industry. We also started an internship, and every summer we have 2 students come in. We're actually in the midst of recruiting right now as we will start interviews February and March. But the internship is as competitive as trying to find diverse talent in your team. So we are trying to get ahead of all of the managers that are also giving out internships this upcoming summer. And so we're trying every avenue that we can. We're thinking about it holistically. We have an emerging managers program, and Rosa Perez leads that. But we have made it all of our responsibilities to find diverse talent, to implement it in our portfolio, and to continue to think about how we can engage and really grow our returns and assets, because our managers are complementary and they are really delivering great returns from that middle market space where they really gravitate to. And that has been something that we also have been attracted to, the middle market space. So it kind of is all aligned for us.
That's really remarkable. And it reminds me of this concept of corporate responsibility we speak about a lot. We tend to speak about that in terms of large corporations, but asset owners too, we have responsibility both to our stakeholders as well as the community at large. And I've never seen an organization take it to the level you have. It's interesting that you look for feedback. I can't imagine how you could do any better than this engagement, which seems very intensive and helpful. Do you, on the seeding side, when you say an emerging managers program, would you invest with first-time funds? Do you seed managers?
Absolutely. We've actually invested with quite a few. What we look for is all of the things that we would look for in a majority-owned firm: people, processes, organization, investment, philosophy, risk, the same exact evaluation and metrics that we evaluate a majority-owned manager is how we evaluate any manager. But we also really look to, has the manager been able to demonstrate that they can run the strategy? Do they have deals? If it's a first-time fund, they are not a first-time investor. And so we look to see the deals that they've completed, the exits that they've completed, and we use that as their track record if they're not spinning out of a larger firm and are able to bring that track record with them. And so we gain comfort by getting to know the manager. It's not overnight. It takes time. It takes monitoring them over a length of time. And so once we feel comfortable with the past track record, we don't have a problem with investing in a first-time fund. But we understand that first-time fund depends on the team, depends on the portfolio manager, depends on them being able to really demonstrate their success in investing and exiting and finding companies and obtaining a pipeline of opportunities. And that's what we look for.
Those extraordinary efforts. And thank you on behalf of the industry for the work you continue to do. And my last question is, I know you've had a long string of awards, and we'll list some of those in the show notes, and congratulations on those. You also recently spoke at a World Pension Summit in Europe. And I'd love to hear what you heard from your peers there that you feel you'll be thinking about developing further in, say, if you look to the next 5 years, what's going to be, you think, at the forefront for pensions?
Yeah, I think it was a sharing of ideas. It was just fabulous to talk to my peers. my CIOs from France, from Germany, from the Philippines. There was people that traveled for days to get to The Hague, and concerns about the markets, about, inflation, about the macroeconomic environment. But we thought a little differently about ESG outside of the US. It is a major component of investing. And I wanted to do a little bit more digging around how to continue to have our managers really key in on those sustainable investments, because I feel like that protects us long term from risk when our managers are not necessarily, investing in an ESG fund, but are considering those factors in every part of their investment lifetime. So those are some of the things I took away. And I think they took away from us, like, we are at a different place as far as diversity. And diversity means something different when you leave the US. And so we had a lot of talks about diversity and what it meant in the US, and ESG and what it meant outside of the US, and political concerns and geopolitical risk, and being able to invest without some of the regulations and the divisiveness. And so, those were some of the conversations, and it was just so interesting. And it was so great to talk to people and understand, what they thought about. I think when I was over there is just right before or right after the Israel conflict, and really talking to people from different countries and how they thought about it and what they thought about the migrant crisis. It just opened up different thoughts about how we could look at ourselves, really, and do better. So I think those are some of the things I took away. Some people that were far along in investing internally that I now have as resources to pick up the phone and call and say, what do you think about this? How would you think about advancing this? Some that have already had private credit portfolios. So I was really just picking up ideas that I could use in my portfolio.
Sounds like a great forum. So any final kind of thought or word of wisdom that the last few years have taught you? And I'm thinking in particular about that work you're doing with emerging managers.
Yeah, I just think when we look back in our careers, both you and I, we just don't want to leave anything undone or look back and say we had opportunities that we didn't take or didn't use our platform to the fullest to make a difference. And that's kind of what drives me. I want to make a difference, and I want to take every opportunity that I had, and I want to use this platform in the fullest way because it is a blessing to have.
And this has been a great conversation. You've spoken about future-proofing your portfolio in this way. And I think about, on a broader scale, future-proofing the entire IMRF pension fund. And the way you speak about the way it's always on your mind, it reminds me, we're both parents, we're both guardians, that being a guardian is a 24/7 role. And I see you as a guardian of these funds in a way that is a role model to many. So thank you so much for coming here, for giving this update, for keeping up the great work you're doing, and for being such an extraordinary steward of capital. And thank you again for the kind words. You were the origin of this podcast. I've always said that. Your story needed to be told. And as this has exemplified, it should be told over and over again. So thank you so much for coming here and sharing your insights with us.
Thank you. Thank you again for having me.
I'm Aoife Devitt. Thank you for listening to the 50 Faces podcast. If you liked what you heard and would like to tune in to hear more inspiring investors and their personal journeys, please subscribe on Apple Podcasts or wherever you get your podcasts.
This podcast is for informational purposes only and should not be construed as investment advice, and all views are personal and should not be attributed to the organizations and affiliations of the host or any guest.